Welcome to Real Talk, Real Estate Discussions with Andrew Kirsh. In each episode, Andrew interviews industry leaders. We'll hear their real-time opinions on today's market, their background and unique career highlights, and guidance for newcomers into the industry. You can find this show at sklarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Now here's the host of Real Talk, Andrew Kirsh.
Welcome to another edition of Real Talk. There's a lot more transactions happening out there in the marketplace, but it doesn't mean that it's easy to transact. Equity is still being very picky, but equity is now more interested in potentially transacting and ultimately transacting. And there's all different types of equity that's either sitting on the sidelines or wanting to dip their toe in the transactional market, from common JVLP equity, preferred equity, platform equity, co-GP equity. And so I thought it was apropos to bring on Aaron Greeno from Arselle Investments to come onto the show and talk about his new platform with his partner, Kev Zorian, and describe where they're going to sit in the cap stack, the type of operators they're looking to partner with, and how they're viewing the market today. So I hope you enjoy my conversation with Aaron Greeno. Welcome to another edition of Real Talk. I'm here with my good friend Aaron Greeno of Arselle Investments. Aaron, thanks for coming into Sklar Kirsh. I really appreciate it.
Very much appreciate it. Glad we get to do it in person, and thanks for having me.
So I think this is the largest disparity of height that I've had on my podcast. So people know that I'm 6'3", so you must be at least 7'4".
Yeah, you strategically set the chairs, and that's how the conference tables, I guess, are hopefully equalizer.
Yeah. Well, how tall are you?
6'4".
And so 6'4". Okay, I think I had a couple clients that were like 6'6", 6'7", but basketball, volleyball, I forgot. No, we
football.
Football.
I played football for college. So many moons ago at University of Miami. Actually, funny story. Part of what brought me to LA was first time I was here was actually playing in the Rose Bowl.
Oh wow!
And
for
University of Miami.
Oh,
So
gosh,
I played Nebraska in the national championship, and it was very unique to actually have a Big Ten Pac-10 at the time school playing in that. So it was fun, but also met my wife during that period, and just a couple of weeks we were here, we lost touch for a very long time. But part of the draw of me coming back here, me coming for grad school, went to UCLA for law and business school, and then eventually moving back full time. It was very serendipitous, I guess, set of events.
That's incredible. So wait, who'd you guys play in the Rose Bowl?
Nebraska.
And who won the game?
We won the game.
All right. Did you end up winning the national championship?
We won the national championship.
Where's the ring? Where's the bling?
So a lot of people, and I know we're in California, there's a lot of SC people will debate me, but it's it's sort of in that debate of the best team ever. And I tell people I was kind of the worst player on the best team ever. I think you gotta, at least have something on the stat line to be able to wear the ring externally, but it was still a good story, and awesome experience to be part of that level of excellence. All kidding aside, played with some really great guys. I know the U gets a rap a little bit, but that team had really solid individuals, kind of top to bottom, and the leadership, and I think the level of detail and commitment that it took to get to that level was something I had never been a part of, candidly, and I think really opened my eyes to what work ethic really means when you're striving for a goal that lofty.
Yeah.
And we had a bunch of guys that the prior year we had gotten close, and it was that BCS drama where us in Florida State were going back and forth by hundredths of a point, and we had beaten them, but we had a loss to Washington, and we ultimately got squeezed out of the national championship game. And so I think there was a lot of rawness on the team, and we had a couple rising seniors who could have gone pro, who came back, guys like Ed Reed, who came back to really have another shot at a championship, and that level of focus where it's like, I'm giving up millions of dollars because I want to invest in this, but like everybody better be here for 6 a.m. workouts at 5:45.
Yeah.
It was cool. It was cool to be a part of.
Well, now I feel completely inferior when I talk about my college baseball prowess at Northwestern, and hearing you play at the Rose Bowl,
for University of Miami, who won a national championship. Yeah, I can't talk about my baseball skills.
No, I mean, look, it's all. I think for folks who do something, whether it's sports or other large commitments, just doing something at that level while trying to get an education and juggling a 50-hour or whatever plus schedule, and travel and all the other things that come with it, and still managing to get an education and figure out your career after. I think it does give you the benefit of some perspective and some time management that I think a lot of college kids maybe don't get, and I sort of credit that a lot with my success. I don't know if you have a similar field, but
absolutely. When I see athletes on the resume, I'm more gravitated to talking to them because I know how hard you have to work in order to excel still in school and also excel on the playing field. So by the way, I have to admit I'm reeling right now because last night I coached my son's 8U all-star team, and we've been playing for 2 months, and we just lost in the championship game 10-9. And we blew a 7-1 lead. We've been up in Camarillo for the last 2 weeks. We played the host team in the championship, and we would have moved on to North Hollywood. And so if I'm not if you're not sensing the full Kirsh energy,
right,
I'm a little down today.
Right.
So.
I'm sorry to hear that. That's heartbreaking.
It's okay.
Yeah, I emailed you yesterday. I think I got a reply that you were coaching, so I was rooting for you.
Yeah.
Sorry to hear that.
It's all good. All right. So should we talk real estate? We've talked sports. We talked Little League, and
why don't we?
That's why you're here. So Arselle Investments. Tell me about it.
So my partner Kev Zorian, who some of your listeners, many of your listeners probably know, and I worked together for a very long time at Morgan Stanley. My kind of career pre that was I got into law school and business school at UCLA. After college, did a JD MBA there, and ended up going. Was very close to going the legal route, and interviewed with some of the firms that you worked at previously, and had offers from a couple of them. But ultimately, it was kind of 2005, 2006 as I was interviewing, and it was go-go days, in Wall Street, and decided I would go the path of big commercial real estate, and joined Morgan Stanley out of school. Kev, my current partner and former colleague, was kind of head of the LA office at that point, and so was one of the people I interviewed with and spent a bunch of time with. And I ended up going to New York, spent about 8 years there, but really started my career June of 2007, Morgan Stanley real estate, peak of the bubble, and walked in the door, and it was kind of investment banking and private equity, and just seeing the deals and the scale and the leverage and everything was pretty eye-popping. And then the resulting implosion and what that felt like to kind of be ground zero for that was definitely a learning experience, pretty scary, obviously, and interesting at the time, but also one of those moments where a lot of people in the middle sector got blown out. Our industry really experienced such a kind of cataclysmic moment that so many people got washed out. There wasn't a lot of positions available, and Kev, coincidentally enough, kind of started his career in the early 90s post SNL, and it was sort of a similar moment where I think we sort of share these vintages where it's just a little bit thinner in terms of head count, because so many people blew out, did other things, couldn't get jobs. And as we kind of evolved our careers, I ended up spending 8 years in New York, came back here. Ultimately Kev was running the West Coast. He became head of U.S. investments. I became co-head of he became head of U.S. asset management. I became co-head of U.S. investments with a colleague in New York, and we kind of ran the West Coast together. I ultimately left to go to another firm called Dune Real Estate Partners for a few years. Spent 5 years there building and running the West Coast, and wanted to be a partner in a smaller firm that was more kind of pure play opportunistic. But ultimately, as we started thinking about Arselle, to bring it back, a lot of our conversations were around looking around at our operating partners, looking around the industry, and just sensing this really big leadership change coming. And whether it's succession issues, and looking at kind of the cohort of founders of a lot of our operating partners, and looking at some of the younger folks who have been, kind of ready to do something different, and feeling like they were ready to grow, but didn't necessarily have, the off ramp or the capital, or necessarily the institutional experience to do it effectively. We felt like we had a role to play in that. And I think he and I had talked for a long time about what if one day we did something, what could that look like? And he had hit his 25 years at Morgan Stanley, and we were coming to the end of a fund at Dune, and kind of at that period of, do you stay and raise another fund and kind of reinvest, or do you do something different? And I think the capital markets and where the world was felt like it was coming to a pretty interesting time where, obviously real estate values were off massively, and you kind of had this cocktail of, rate driven repricing and then fundamental impacts on asset operations that have kind of compounded that, where you've got both the yield and the NOI going the wrong direction in a lot of assets. And then the asset management's just challenging. And you've got folks who have been doing this a long time and have been really successful, but aren't necessarily interested in continuing to have the same level of engagement or put in the same amount of capital investment. And we thought, this is as good a time as any to jump in and try to do something. And so what we've developed is a firm that's really kind of strategically aligning with operating platforms that we feel like we can add some value to, and trying to use that to access real estate deals across a handful of asset classes that we think we have expertise in and think are poised to perform well. And so we're pretty excited about it. We're 3 months old officially, but I feel like we've been talking about it for a while, and so I appreciate you having me on.
Yeah, absolutely. Well, I mean, you and Kev are two extremely well respected professionals in the industry on the capital side. First, let's talk about Arselle. What is the genesis of the name Arselle?
Sure. No, it's a good question. A lot of people ask that.
Yeah.
So Kev and I both come from families of immigrants. So Kev's family came over from Armenia. My mom's side of the family's from Haiti. Both countries that are, have had storied histories and have had, a fair amount of turmoil. I think we feel like they're filled with good, hardworking people that have, kind of unfortunately resulted in not great economies and a fair amount of strife. And it's always been, I think, one of the ties that bonds us is that, hustle that comes from that. And I think seeing, our parents come over and invest in our education and kind of give us the opportunity to do what we're doing. We're, sort of aligned with that. And so we wanted to remember that kind of in the fabric of what we're doing. And so Arselle is actually a combination of the name of the highest peak in Armenia, which is Mount Aragat, and the tallest peak in Haiti, which is Peak LaSalle.
Wow.
Which is why I feel like at our logo, there's kind of two peaks in the A.
Yeah.
And, just wanted to remind ourselves of, a little bit of where the lineage came from. And, candidly, I think we're both just so grateful to have this opportunity to start a firm, right? When, family came over with nothing in the kind of 60s, and, I at least have this opportunity to give it a shot. So
yeah, no, that's great. I feel like it's always difficult for companies to figure out what their name should be, and there's so many companies where, whether it's Black Rock or Blackstone or Rockwood, it's like and then there's water in so many companies.
Yeah.
The fact that your name is both meaningful to both you and Kev and distinct and unique in a market where there is a lot of competition, picking the right name is critical.
Yeah, no, look, I think we certainly went through a lot of the iterations of, is it a Greek god and should all the stones and trees and, streams are taken. But I think we wanted it to have some meaning without it being corny. And, I think we felt like it was a little more subtle and kind of meaningful to us without kind of being cheesy. At least that was the goal. And we're thankful to, I think, develop a logo that kind of gives a nod to it. And so, yeah, look, we're appreciative, and it's been fun to kind of tell that story, because we didn't really tell anybody about it, beforehand. We kind of launched, and as people have asked, we've given them the background. It's like, oh, I thought it was, the unfortunate part is it's also the name of like a clam dish in,
okay.
And so, some people I Googled it and I got like a Winnie Bungle kind of looking thing.
Well, as long as it tastes good.
Yeah, exactly.
So we're in an interesting point of the cycle. Over the last, 3, 4, 5 months, we've been really busy, Sklar Kirsh, transactionally. And I'm not talking about, loan modifications and workouts and more defensive transactions. I'm talking about more even offensive transactions across many of our asset classes throughout the country. And I also have a segment of my client base who is still frustrated that they want to do deals, but the return profile of capital is so excessive to what the operators are saying is is realistic of what you can earn today.
Mhm.
So in one respect, we are busy, but in another respect, I'm hearing a lot of frustration that there's just a misalignment as to expectations of returns.
Yeah.
So how are you perceiving the market? How are you able to transact, and is your return profile just different than your competition?
No, it's a great question, and look, I think as we sort of step back and look at the market broadly, right, and you look at the areas where people want to spend time, and okay, I want to go buy newer vintage residential in good markets. I think that's a great strategy. You can get a discount to replacement cost, and you have this supply wave that's falling off a cliff, and you've got rent growth after. And then you go try to uncover some deals, and you're like, why is everything a 4.5 cap? And the treasury, today it's I guess down to 4.3 or whatever, but kind of bouncing around in that mid fours range. And it gets hard to wrap your head around. And then you say, okay, well, then let me go look at something that's a little less distressed, and retail's been kind of the belle of the ball, but now that's compressed, and you can and so I think as you look at it at a high level, it is hard to say, let me go buy the index of something today. And I think there's still a huge bid-ask spread where fundamentals in some of these asset classes relative to what you need to underwrite to actually win a deal today, absent some massive distress kind of unique situation, there's a pretty significant bid-ask spread. So I think as we look at it, the model of let me go just allocate to a strategy kind of blindly, I think is a little bit harder. I think we feel like local expertise really matters, micro locations matter, business plan execution matters, and that was part of I think our transition to getting to the sort of operator side of the equation was, I think last cycle there was a lot of cap rate compression and rent growth and macro factors, and you'll have things obviously that influence that we don't see again. But I think there's just a lot of kind of rolling your sleeves up and earning your capital and actually adding value in some of these deals. So from our standpoint, part of what we've tried to do is go into situations where with the respective platforms there's a wider range of cost of capital that can be accessed with the core skill set. So for instance, an industrial partnership that we have has experience doing heavy entitlement and adaptive reuse and land development and vertical development, but has also done an awful lot of value add and light value add and small bay and property management. And so the right moment as the cycle moves for what you want to focus on, I think is something we want to be in platforms where there's sustainability, where you can really go into the moment now and say, what, I really like small bay industrial and infill class B in SoCal because I think it's way oversold, and I can buy it at the same cap rate I can buy Phoenix for with less supply. And yes, there's a bunch of headwinds, and I understand all that, but there are supply constraints, and there's 20 million people and all these things. Okay, well that might work now, right? And then when that trade gets crowded, it might be time to develop again. And so we're trying to have a little bit more sustainability in terms of being able to access different costs of capital based on sort of what we think makes the most sense, purely from a risk return, risk adjusted basis standpoint, and also capital availability, right? As much as I would love to be a purist, you can't buy anything if there's no LP capital for it. And so I think that's what we're trying to do, and we're trying to do it across a couple different sectors. I would say what we're finding is, one, I think we're glad we're small, and I think intentionally so. We didn't want to go out and build this giant behemoth or go join a big platform, because I think we like being able to sharpshoot and really cherry pick specific opportunities. And two, I think relationships really matter, and in particular how we're going into it. I think there's a lot of trust in some of these situations where they're more, whether it's a recap or whether it's a, kind of a quiet sale, or it's a, portfolio that needs to get figured out. I think people are looking for folks they can trust, that they've worked with before. And, that can sometimes close that gap a little bit. I think it's tough to steal things today. But I think the reality of the capital markets is lenders are starting to get a little bit frustrated. It feels like with just sitting around waiting, they're being more aggressive. We're starting, we have some assets we're looking at that are effectively trading for the debt, where the lender's like, I can get out whole. And sorry, equity, I gave you a couple of years, but it's time.
I had that conversation this morning, and somebody asked me, are you seeing distressed? I said, in office for sure.
Yeah.
We're seeing more transactions. I'm just seeing lenders, we're at the end of their patience. It's mid 2025.
Yep.
Rates have not come down. They don't see rates coming down meaningfully anytime soon. They need to get rid of these assets. It's
Absolutely.
time to.
And look, we didn't, we over levered some things, but generally broadly as a market, we didn't over lever. You kind of, a lot of these things were 65% levered and values drop 20, 30%, depending on what it is. And,
Right.
Residential's come back a little bit. And so maybe there's, the debt clears and, 20% of the equity still there or none of the equity still there. And, whose problem is that? And it turns out, a lot of these lenders have given some rope, but they're kind of getting to the point where they're willing to force the issue. So I felt like transaction activity was starting to pick up, and then you ran into some uncertainty around policy, and obviously domestically in LA, and I know as well as anybody between the fires and some of the other things we've experienced here, it created a lot of space where nothing could happen for a bit. I think there's a lot of capital that's kind of still on the sidelines, but is maybe misaligned from a strategy standpoint with where they can actually hit their cost of capital. So a little bit to your earlier point, right? It's like you might want high teens, but you want it in, brand new multi, or you want it in, very certain type of industrial with cash flow and lease term, right? And I think that's going to continue to evolve, but I'm starting to hear a lot more people that are like, maybe we should look at office, right? And you're starting to see some of that stuff trade. And I think, I think if we can get on the other side of some of this geopolitical turmoil and some of the policy uncertainty, and at least understand kind of what the next phase looks like, whatever that is, as it relates to tariffs and taxes. And I think Kev, said the other day, tariffs, taxes, and trepidation, or something like that. But I think if you can get on the other side of that, it's at least investable. I don't know that anybody's going to underrate a lot of long-term rate curve release. So it's really how can you kind of generate cash flow and find good investments. But it does feel like the lender-driven side of things, to me, is going to continue to pick up.
Yeah, I mean, look, multi is always going to be our largest asset class in terms of what our clients are focusing on. But a close second now is office. We're doing deals in downtown LA, in Venice, and Pasadena, and San Francisco, and others. But let me drill down as to the type of operators that you're looking to partner with. And obviously, there's of the entire capital stack. Once you get past the senior debt, there's players for pref equity, mezz. There's traditional LP that you at Dune and Kev at Morgan Stanley had provided. There's co-GP capital out there. There's platform capital, platform equity. So
when you say that, it feels crowded.
Yes, but there's also so many different opportunities to place capital. So an operator client is coming to me saying, Kirsh, who should I talk to for this particular project? So what is the ideal scenario for you where you want to play in the cap stack or the relationship platform level? If you could just drill down a little more for those operators out there.
Well, look, I think primarily, one, we're looking for interesting real estate opportunities with good people. And I think as we look at our Venn diagram that we kind of put together, right, the top bubble is really culture and cultural alignment. So I think, look, living in the institutional world for a long time, part of starting a smaller platform that we control is we can do business with people we like. And I found building those long-term working relationships has been really beneficial. And so I think, first and foremost, is somebody who kind of thinks like we do, has alignment from a cultural standpoint in terms of how they look at deals, how they underwrite deals, how they treat their people, ethically, how they behave, all that stuff. And that's absolutely critical. And then I think, in our alignment of asset class interest, right, I think we're interested in industrial, we're interested in residential. That'll end up being probably, 2/3, 60% of what we do. We're spending a lot of time in the retail space. We're spending a bunch of time on a few alt storage, medical, to kind of name a couple, all with different strategies, right? And so I think understanding our macro view of a certain strategy and where we think we can play and be successful, whether that's, a roll-up strategy or it's, a wholesale to retail strategy, whatever it is for the given asset class at this moment, and then finding somebody who can execute that. I think in terms of profile, look, if you're Heinz, you don't need us. We don't really add any value. And you've got people who do all these different things. I think, Kevin and I look at ourselves as problem solvers. We both worn a bunch of different hats, covered a bunch of different geographies, dealt with a lot of different partners, have lived things cradle to grave. And, at the same time, there are platforms where we're complementary and there are platforms where we're like a little bit redundant. So I think, a group where they recognize the value we bring in terms of capital markets, in terms of deal structuring, in terms of, rolling your sleeves up, work ethic, in terms of relationships, and also bringing capital to the GP side. So, I think a GP that could use more capital on the GP side of their deals and balance sheet, for financing purposes, is willing to, I think, have someone help in the overall execution of the deal and kind of values that. I think those are the best situational fits for us. And then just overlaying that to, an asset class that we think is interesting and that we think can grow. I think that, that's a simplistic answer. And then the other side, I would say, and that can really go the barbell between legacy platforms where maybe there's been some leadership transition or turnover, or they're looking to, grow a different way or replace an investor. And we're seeing a lot of these situations now. The pipeline's been pretty extraordinary, actually, in terms of situations where there's something going on in the leadership or the ownership of these organizations, and they're trying to figure it out. And at the same time, still trying to go do deals. And we see them as having, really great operating capabilities and the ability to execute, real estate transactions. But at the same time, the company itself, could use a little bit of extra something to kind of get over the hump or grow. And then separately, the emerging operator, kind of bucket, where there's just a lot of younger, hungry folks out here who, because of what's happened in our market the last couple decades, really have just never really kind of built up the type of balance sheet that, that they would like, but are otherwise ready to be on their own. And I think we can be helpful in both regards.
Yeah. And so will you help source LP capital for these operators as part of this?
Yeah, we look at ourselves as true partners. So when we're signing, I think that's a little bit the difference between, you mentioned all the different buckets of capital and between a call it a traditional co-GP, type of arrangement versus what we're trying to do is, we look at that as a little bit of capital and maybe balance sheet, and every now and then maybe some high level advice. We're really looking at ourselves as true partners and rolling our sleeves up and helping, in any way. That could be, helping raise LP capital, that could be negotiating financing, leveraging relationships, going to city planning meetings. I think we're sort of there to kind of bring our full toolkit and candidly our team. And we've got there's 5 of us now. We've been fortunate to have some great folks come work with us that we've worked with in the past that, kind of understand how we work and what we're looking for. So I think we're really bringing a very high level of kind of underwriting capability and structuring capability in addition to just, kind of hustle. So, we're hoping we can add value to some folks.
Yeah. So look, in terms of we live in a world of disintermediation in all aspects of life and in the workplace. And in one area, that I'm curious of your thoughts of that in real estate is with LP capital. And the allocators of LP capital have always been seen as, okay, in order to, you're Mr. Operator or Miss Operator, you're not going to transact with the pension funds and the endowments and sovereign wealth funds. We're the gatekeepers. We will allocate that capital to these operators. Do you think that we're going to eventually live in a world where those operators, and maybe with your help, get around those LP allocators and go direct to those pension funds and those endowments and those sovereign wealth funds?
Look, I think disintermediation is a great word for it. I would phrase it a little differently, which is I think the pie to alts is growing. I think when you add in everything coming from RIAs and high net worths, and as the kind of baby boomer generation is aging and that wealth transfer is happening, I think the pie that will have a need to invest in alternatives is growing immensely. I think the nature and sophistication of a lot of those investors is changing. And so, look, I lived in the allocator world for a long time. I think there's certainly a place for those firms, but you do see a lot of consolidation happening because you also, I think, see a lot of the larger LPs wanting, more of a one-stop shop, and it's becoming harder and harder to run, small independent funds with all the compliance requirements and everything that you have to do. And so I think there's a world where those companies are great and we love to do business with them and they exist. I also think there's a pretty significant trend of LPs wanting to invest directly, and that's family offices, that's pensions, that's sovereigns to a much more scaled extent, endowments. And I do think part of what we're bringing is I think there's a lot of people who don't want to pay direct promote anymore and would rather figure or double promote anymore, and have tried to build out an in-house capability to kind of underwrite real estate. And they say, we want to go direct. And then they try to figure out what that means. And they realize that they don't actually know how to differentiate one operator from another, or, if somebody's going to be able to do the reporting they need, or how they're going to handle risk management. And so I think part of what we try to bring is a little bit of that institutionality and experience to help some of these operators scale to be kind of directly investable from some of these more institutional LPs. And I think that is something you'll continue to see. I do think it's hard in a small, local regional type of operator construct without a little bit more ballast. And so that's where, one of the places we think we can add value, especially around more programmatic strategies that we can build, where it's not necessarily a one-off deal thing, but we spend a lot of time now talking to LPs about what do you want to do and what does that look like? And as we're thinking about our platform relationships, is there something you can match on both sides of that? And what's the right capital for the right strategy? And I think one thing, back in Morgan Stanley days, we had a very large open-ended core fund, prime property fund, which is, now I think the biggest in the world. And then we had the opportunistic business, which is the flagship, Mesref North Haven fund series, some other stuff too, but those were the big ones. And living through kind of complicated business plans where we were invested on the core side, but with, lower to no leverage and kind of a longer horizon hold period and more of a programmatic view on it, we were able to realize some really great outcomes because it was structured correctly, it was capitalized right, the capital was patient. And on some of the opportunistic business plans, you kind of needed to get in and out, and that worked for that too. But I think just thinking about what's the right capital structure and the right capital, period of these different business plans, and trying to really match up, not just everything being a 5-year hold that you got to sell and, remonetize, but actually trying to put the right mentality of capital, around the right strategy to really maximize value over time. And I think with the way we're addressing the business, we can be a little bit more customized that way. So that's part of what we're trying to do.
Yeah. All right. Let's talk about geographies.
Okay.
It's a big debate, not even a debate, I would say discussion point. When I'm trying to help clients raise capital, I can see right when I'm sending off these emails of the reaction that I get from.
Do you have a read receipt notification for the ones that?
Yeah. And so, the reactions that I am now getting and have been getting for the last couple of years is absolutely no on Pacific Northwest, no on LA, pretty much no on many blue states. And yet there's also a concern of oversupply in certain red states and red markets, Dallas, Phoenix, Vegas, Florida. Okay, so where are people transacting? Everyone has an excuse not to transact in a particular market. So I don't want to, not that there's any state secrets here in the real estate business, but what are some of the markets that you are more bullish on?
Yeah, no, that's a good question. I think, look, the first leg of our business, we really wanted to, partner with platforms that we know that are local, that we can go drive there on a minute's notice and talk about a deal and hop in the car and go see, get on a 1-hour flight. So we've organized our initial focus really in Denver West, kind of in what I've covered for the last period of time, and kind of spent a lot of time in those markets. So our initial focus is certainly there, and kind of within that, all markets are not created equal, right? There's platforms that are based here that do stuff everywhere. I think depending on asset class and depending on, cost of capital, it's a little bit of a different answer, right? I think San Francisco, for instance, which is not a market we're in right now, but one that, I find really interesting, right?
Sure. It
had such a drastic, diminution of value and arguably, city fabric, kind of at the same time, and has really turned around both in terms of kind of local politics as well as, what you've started to see in terms of interest in actually investing there. That's a very interesting case study, right? Is it right to go in as a core investor there now? Maybe not, right? But from an opportunistic value add standpoint, I think people are starting to make some smart bets in that market. The Pacific Northwest, you mentioned, Seattle took its lumps as sort of a San Francisco junior, I think, a little bit in the last cycle. And we own some stuff on the east side, but got to see sort of the dichotomy that was producing. It was almost a downtown LA Century City, type of vibe. I think as you walk around Seattle now, it feels a lot better. And, we've actually looked at some transactions there and been pretty surprised at actually how aggressive pricing is starting to get on some of them. We still like the market on a relative basis and think there's some interesting things to be done there. But, it does feel like it's recovering, maybe a little bit of a different story than Portland. And I think if you look at the drivers of, AI and, really where educated workforces want to live, I understand the sort of red state thesis as it relates to regulation and some of the problems that these cities have had, in particular since COVID. When you overlay all the supply that came into some of those cities, I do think, to your point, you got to be a little bit careful. So do I like Phoenix broadly? Yeah, I like Phoenix. There's tons of economic activity going on there. I think it's great. I think you got to be careful and you got to look at the micro location and the positioning of what you're doing. I don't think you can just go buy a 500,000 square foot industrial building in the Southeast Valley and hope it's going to work out without a broader thesis around it and kind of really understanding the deal. Southern California, I'm probably, not as bearish on as other people. I think LA, city of LA, obviously there's a lot of headwinds there. And I don't know if, especially in terms of residential, if pricing, has really reset to kind of where it needs to work through some of that uncertainty. But we're spending a lot of time in the, kind of outer suburbs and kind of other adjacent cities down to San Diego and spending a fair amount of time in Orange County on some different opportunities. I think the infill, industrial trade still kind of between, LA, mid counties, Orange County, I think is still pretty interesting if you could find the right asset. So we're looking all over. Denver's been one that kind of surprised me in terms of, I grew up there and I always have a soft spot for it. And you look at historically the population growth and job growth that it's had and the rent growth that came along with it. And for the last couple of years, it's kind of stopped.
Yeah.
And you've continued to have delivery of residential and you still have investors wanting to go there. You just don't have the absorption and you haven't had the sort of the underlying fundamentals. And so, I think we're trying to look at it from a short-term lens as well as kind of a mid to long-term lens and all that relative to kind of basis and replacement cost. So I would say right now there's no clear, oh my God, it's so obvious to me that that's the market. Let's pile in there, right? I'm sure Dallas was that for people a few years ago, and Austin was that until it wasn't. And some people feel that way about Nashville. I went to school in Florida, and seeing the run up there, kind of in the face of climate-driven stuff and insurance that is getting unavailable, if not if not prohibitively costly. And things continue to run, right, and all of these things, to me, it's sort of what's your price and what's your entry point. And we've done so much around the country and so many different structures that I think there's a lot of places that can make sense at the right basis with the right business plan. To me, there's nothing where I'm like, I'm just going to go back the truck up in that market, give me $1 billion, I'll go buy all of that, right? I think and thankfully we don't have a firm where I need to make that call, but that's, I know it's not a terribly specific answer, but that's kind of how I feel about it. It's more, we got to turn over a lot of rocks and we're looking a lot of places.
I appreciate it. All right, final question, or at least final professional question. I may ask another college football question. Let's see, it's June. College graduations probably already happened for most folks. And I get a lot of inbound inquiries of, okay, I'm 22 years old. Where should I start my career in real estate? And this is independent of law. This is just people wanting to be in real estate. I'm sure you get those too.
Yeah.
So if you were back to, after your playing days, you're 22 years old, you can go brokerage, you can go capital side, you can go operator side, service side, so many different avenues to get into the real estate business. What do you tell a 22-year-old who's graduating now in a very, I'm saying, it's an interesting market.
Yeah. Yeah. Well, we are growing our team a little bit and looking for an associate, but that's probably 2 to 4 years out of school with the experience already there. But have some advice for those folks too. But look, I think I've always told people, go somewhere, and depending on what they want to do, obviously there's a lot of different segments to this business. You can do a lot of interesting things, but assuming somebody wants to be on the deal side, go somewhere where you're going to do something really analytical and get deal flow. And that could be a lender, it could be a broker, it could be an asset management shop. There's some good ones now that are doing some really complicated, interesting work, and go work for people that you actually respect. And I think young people get too caught up on, I want to do private equity, or I want to be a developer. I want this profile of job to say it's what I'm doing. I think there's a wide range of jobs where you can get training. I think you need to understand to your point on disintermediation, like where is AI going to come for first, and how do you kind of get out ahead of that? But I still think you need to learn a lot of what AI may end up disintermediating, right? You need to learn how to model, you need to understand transaction structuring, you need to have enough flow where you see stuff. And if you're in an active lender or an asset management shop or a broker that's representing a lot of people in complicated transactions, I think you can learn it anywhere. You just got to kind of find that right seat. And I would just encourage people not to get too hung up on the headline of what it is they're doing. You get a lot of people say, oh, I never wanted to do that, I wanted to do this. I think there's a lot of interesting training out there, and kind of finding somewhere where you kind of believe in, you have people you connect with, and you're going to get analytical rigor. I think a lot of the rest of it, the softer skills, the sexy transactions, all that stuff you can kind of get later. I think those early years, you just got to get as many reps as you can, and do it with people who are ethical and are at least going to take the time to train you. And that's part of what I loved about being part of bigger platforms, is you actually have the ability to train people and bring in kids out of college and sit with them and help them grow. And now I'm looking around at my former analyst classes at Morgan Stanley that came in, and guys are running big platforms. I think two of them are running TPG's platform now, right?
Wow.
And it's really cool to see that development. Unfortunately, now we're kind of a small SWAT team, so we don't have as much time to kind of sit and go through it. But I think finding a place where you can have peers that are also learning and be in the flow and just dig into the details of it.
Yeah, and that's amazing. I said final professional question. All right, final one last, maybe two football questions. Best college game day atmosphere.
Oh boy, best college game day atmosphere. That's a good question. I'll tell you, I went to Miami played DC Berkeley this year, and this is a non-answer, but it's a story.
You can't say Cal.
And I know.
Okay.
No, I'm not saying Cal. By no means am I saying Cal. But I'm like, oh, they're playing at Berkeley.
Yeah.
Like everybody says, Berkeley's a super mellow place
Yeah,
to watch a game. My buddy's got a 2-year-old. I have a 5 and 7-year-old. I'm like, well, we bring the kids. And we didn't know game day was going to be there. They moved it from a day game to a night game, and they started game day there at 6:30. And so we walk in with the kids like an hour before kickoff, and the entire city is like, a bunch of lunatics running around. Everybody's been, drinking since early in the morning and whatever. And I thought, well, A, it was a mistake to bring my kids to this, and B, this is not the best game day atmosphere. I don't know. I think the big SEC schools, it's hard to manage. I mean, I look at it, and I haven't been to these schools, but I look at it when they're at like Bama or LSU or Georgia or something, and it's just a different vibe. Like Miami was fun and cool, but it's like an 85,000 person stadium when I was there, and it's a lot of folks from the community, and they're great fans, but you don't get like the whole city shutting down and being there. So I don't know. That's my sort of uninformed view of it. But I don't know. What about you? What do you think?
Gosh, so I'm a Big Ten guy.
Yeah.
I'm not going to say Northwestern. That's where I went. I would say there's nothing when you're at the big house. I hate to admit this, but when you're at Michigan and you were talking about when 100,000, maybe it's now 110,000, and that is their entire weekend.
Yeah.
That or Ohio State. I mean, it's pretty incredible.
I mean, Miami, when we had the Orange Bowl and you were in it against like a Florida State or somebody big like that, because we didn't pack the house against anybody that wasn't top 10. It's just people got other stuff to do. But those games before they tore down the OB, and it's been 20 years now or something, but that was a pretty incredible. I mean, that thing shook, and you felt the nostalgia. You could almost like feel Ray Lewis coming up behind you, giving you a push, right? So that was pretty cool, but unfortunately, it doesn't exist.
So if we watch the Netflix documentary or ESPN on the U, are we going to see Aaron Greeno?
On the U part 2, if you squint really closely and never blink, you might see me walk out for a second. But before we wrap, can I ask you one question?
Hey, I love it.
So I've always been inspired by friends who've been entrepreneurs and gone through the journey and been successful getting on the other side. Seeing what you built here is incredible, right? Any advice for somebody in year one trying to build a company?
Wow. So it's funny. It's like we'll wear two different hats. You have your real estate professionals hat where you could run your Argus models and your Excels and you know how to source deals and source capital. Take that all out the window because it has nothing to do with running a company. And for me, I could be the best lawyer in the world and be super connected out there and connect people and find capital that has nothing to do with me running a 65-person operation and assistants and paralegals and HR and accounting.
Right.
And so what I needed, and I've leaned on my partner, Jeff Sklar, where he is more into the weeds of running our business, but I still have to, be involved as well. And having, you had an MBA, law school, they don't teach you how to run a business.
They don't teach you how to be a lawyer either. So yeah.
That is the unknown secret about law school. So organizations like YPO have helped me, and learning from other CEOs, regardless of industry, of how to run a business is so critical, because we're all in a relationship business, and we are also outwardly focused on our day-to-day affairs with your operators and your capital. For me, it's my clients. We cannot lose sight of the people who make that happen, even if they're not revenue generating people. They're back office.
Absolutely.
And it's not easy, and you have to spend time maturing and developing that business, because look, when you go into any business, whether it's a doctor's office, an accounting office, a law firm, the receptionist is just as important as the person who's providing the service, because it's the first point of contact, right?
Absolutely.
And so having everybody buy into Arselle, like everybody buying into Sklar Kirsh, is part of delivering that service, that brand that you want
For sure.
the marketplace to know. So
For sure. No, like that's a great answer, and I it resonates for sure. Even just being at bigger companies and understanding who really makes the places tick sometimes, right? And that makes a lot of sense. So appreciate it, and look forward to maybe having a debrief here when we get a few years down the road on how I'm doing on all of it.
Oh, please! Between you and Kev, I have no doubt that you guys are going to be one of the, if not already, main players in the real estate industries, given your track record, and more importantly, just given you guys as human beings. You're two of the most well-respected people in the industry. And look, thank you for coming on to Real Talk, and best of luck to Arselle.
Yeah, thank you for having me, and excited we're getting to work on some things together here, and hopefully more in the future, and appreciate it. So.
All right, man. Thank you.
Thank you.
All right, that's another edition of Real Talk.
You've been listening to Real Talk, Real Estate Discussions with Andrew Kirsh. You can catch prior episodes at scalarkirsh.com and on YouTube, LinkedIn, Apple Podcasts, Spotify, Google Podcasts, and more. Thank you for your positive reviews, comments, and for sharing the show with others.